basically like the big index is just I think not a very attractive. And I kind of view us as being in a lost decade where I just don't think the 2020s decade from the recent, peak in 2021, I don't think it's going to be looked back on as a very good decade, especially in inflation adjusted terms, and probably not that great in nominal terms either. And I think this year is kind of a microcosm of that, where I'm not necessarily expecting massive crashes unless officials try to cause like a absolutely severe liquidity crisis. But I'm also not expecting very bullishness action either. I think it'll be very sector specific, and I think a lot of things are just going to be grindy and sideways and choppy and volatile. And sideways can mean down 20%, up 20% in a given area.
Yeah.
And just, when you look back a year from now, 5 years from now, you're kind of like, well, what did we didn't really go anywhere.
The U.S. Federal Reserve is now operating at a financial loss and is months away from having negative tangible equity for the first time in modern history. The financial system in the United States, and for most of the rest of the world for that matter, can be thought of as an Excel spreadsheet managed by the Federal Reserve. That's all it is. Some of the cells on the spreadsheet are assets and some of the cells are liabilities. It's just a ledger that they administrate and that we all use. Keep interest rates high and risk a spiraling sovereign debt crisis. Lower interest rates and pivot to quantitative easing, risk hyperinflation. This is the conundrum that has pushed today's fiat monetary era to the brink, and economic collapse is arguably closer than ever. It's a very toxic combination for the sovereign bond market, says market analyst Lyn Alden. Going back to 2019, I was saying whatever excess there is in equities, I was more concerned about the bubble on sovereign bonds because you had record low yields, and on the long-term horizon, I was seeing inflationary pressure starting to build. She commented, "Historically speaking, we're coming down from the apex of and currently within the lengthy resolution process of the long-term debt cycle, which refers to a multi-decade peak in public and private debts relative to the size of the economy and money supply. This occurs in the aftermath of when interest rates hit zero. We've been in this resolution process for the past 12 years, and the previous time before that was the 2-decade period of the 1930s and 1940s when we hit the previous apex of a long-term debt cycle." In this video, Lyn talks about the interest rate and defensive assets like gold. She also talks about bonds and yield and her macro outlook on the crypto space. As you settle into the video, make sure to give us a like, subscribe, and drop your comments.
Yeah, we had 40 years of declining interest rates, which means, one, you got higher corporate profit margins, but then you also had higher valuations placed on those earnings. And so you had multiple tailwinds causing everything to go up together for like 40 years. And just going forward, I think some of those tailwinds are gone now. We don't really have the benefits of globalization we have over the past 30 years. We don't have the tailwind of ever lower interest rates. And so I think a lot of that is behind us. And now things are in a grindier environment, at least this decade. And that requires more careful sector analysis, more careful company analysis. When things are, it's also like when things are the top of the range, you can like sell covered calls to get extra income and extract kind of more value out of that position. When things have a big down move, you can maybe move, some of your T-bill position back into the market. There's different things you can do to kind of adjust to the ebbs and the flows. And there are sectors that, for example, on the opposite side of this bank problem, for example, like certain energy pipelines, right? What they, like energy product, for example, like EPD, what they did was Enterprise Product Partners, that's the rate. So what they did was basically they borrowed an average rate of 20 years at a pretty low interest rate. And then they have all this, real asset exposure. And so they have, 25 years of distribution increases. They yield over 7%. They have all this low fixed rate debt. And so they're kind of sitting on the opposite side of what all these banks are dealing with, where they lent at long durations at low rates. So one thing to look for is what areas borrowed for long duration at low rates that are fixed and that have variable or real asset underpinnings. And so those are the ones that I think can grind out an advantage over this decade, where they're not reliant on interest rates coming down. They're not reliant on ever higher valuations. They're just operating profitable businesses with their debt denominated in like negative real rates, right, and returning capital to shareholders.
Right now. Yeah.
And so great. I think that there's, between covered calls, whatever tools that an investor's familiar with kind of grinding through a sideways decade is, I think, is the type of action to be familiar with here.
Lyn also talks about gold as a defensive asset. She was bullish on gold, especially at this time of high volatility in the market. She also points out that anything that crashes could be a good buy, but she also warned that it was not financial advice as there is so much volatility in the market. Let us now continue with the video as Lyn talks about bonds, yields, and assets.
I think T-bills, money markets, those are some of the best low volatility defensive assets. I think gold is attractive here. It's possible that gold stagnates for a little bit because, there was a recent buying pressure into gold that might, settle out and normalize for a period of time. But I think that as the Fed kind of finishes their hawkish cycle, I think it's attractive for gold. Like I said, some of those income producing assets that have kind of low fixed rate debt are attractive. And that's kind of the general approach here. I think I've been watching energy producers lately, energy producers, because a lot of that was sold off sharply with the banking crisis. I think some of that's overdone to the downside. Now, I'm still hesitant to be super bullish on energy with a somewhat recessionary outlook. So I kind of caveat that with, I'm not saying we can't see lower, but I am both long-term bullish on some of those. And even in the intermediate sense, I think it's somewhat overdone to the downside. So I think it's worth shopping around or looking around in that space in the weeks and months ahead for, anything that crashes in that space could be a interesting purchase. There's certain tail risks that can happen with the longer duration assets. I mean, if the market, especially the next inflation cycle, if the market perceives that the Fed's kind of given up on their inflation fight, and they expect longer inflation, like basically higher inflation for longer, some of those long duration yields could actually have an upward move. I don't really expect that right away, but it's something I'd be concerned about. I still think that long duration bonds are basically going to give you a lot of volatility without a lot of returns this decade. And so a trader can make use of them, but I'd be pretty careful with them.
About the crypto space, Lyn categorized the space into the Bitcoin space and the other crypto space, sharing that she was only long-term bullish on the Bitcoin space and not on any other cryptocurrency. She also mentions the current Binance fiasco and reasons she is bearish on other crypto assets.
Sure, I view it as two very different ecosystems. There's kind of the Bitcoin ecosystem that I'm pretty bullish on long term. If you look at globally what's happening, Bitcoin and certain stable coins are often used as utility assets. I mean, if people in Nigeria, people in Lebanon, people in Argentina, a lot of people want these types of assets. And some of the development work that's happening on the Bitcoin stack, I think, is really interesting. And so, especially with the Fed, at least kind of near-term peak hawkishness kind of priced into the market. I wouldn't be surprised to see Bitcoin just chop along for a period of time. But I think a lot of the leverage has been washed out. A lot of the kind of the tourists are out of the space, and I'm kind of bullish on that space with a 3 to 5 year view. As for the kind of the rest of the crypto space, I just don't really touch it. I don't think it's there's all sorts of regulatory uncertainties. Coins come and go. They all have their pump and dumps, their moment in the sun. A lot of them are centralized. The VCs actively promote them while using them to get out of their positions. We see increasing regulatory action. We just saw, for example, Binance under pressure legally. Really, that kind of whole casino crypto yield space is just not attractive to me. There's elements of innovation that are happening that I think, as things blow up, maybe that can be taken and put somewhere else. But really, that whole kind of playground of that crypto casino thing is just not an area that I really go into. I think Bitcoin is basically the signal in that space.
Still, on the crypto overview and Binance fiasco, the United States regulators are seeking to impose a ban on the world's largest crypto trading platform, Binance, alleging that the firm has breached financial laws and operating in the country illegally. According to BBC, the lawsuit from the Commodity Futures Trading Commission, CFTC, said the firm cultivated U.S. business while failing to register properly with authorities. It accused Binance of breaking numerous U.S. financial laws, including rules intended to frustrate money laundering, but the cryptocurrency firm defended its practices. It said it had made significant investments to ensure that U.S. users were not active on the platform, including blocking users identified as American citizens or residents, or who had a U.S. mobile number. This filing is unexpected and disappointing as we have been working collaboratively with the CFTC for more than 2 years. Nevertheless, we intend to continue to collaborate with regulators in the US and around the world, Binance said. The best path forward is to protect our users and to collaborate with regulators to develop a clear, thoughtful regulatory regime. The CFTC also said Binance had been active in the US since 2019, but never properly registered with the government or complied with relevant US laws, using an intentionally opaque global corporate structure in a bid to escape oversight. Riding on the wave of the FTX contagion, new development uncovered a new indictment of the FTX founder Sam Bankman-Fried. Liz prosecutors on Tuesday unveiled a new indictment against Sam Bankman-Fried, accusing the founder of the now bankrupt FTX cryptocurrency exchange of paying a $40 million bribe to Chinese officials so they would unfreeze his hedge fund's accounts. The new bribery conspiracy charge adds to the pressure on the 31-year-old former billionaire, who now faces a 13-count indictment over the November collapse of FTX. There is so much action going on in the financial system and crypto world, history suggests that there would be no coming out of this unscathed. What do you think of the macro outlook of the economy at this time? Let us know your thoughts in the comment section below. Also, don't forget to give us a like, subscribe, and turn on notifications. Thanks for watching.